If you're tuning into the news these days, you're bound to hear talk about the potential impending impeachment of Donald Trump. Clients have called in wondering how this is going to affect their portfolio. How are you feeling about this issue, and what should you be doing about it? I'm Anna Hilberry. Don't forget to like and subscribe to my YouTube channel. In order to have a good understanding of how potential impeachment proceedings against President Trump might affect your portfolio on the stock market, we need to look at a little bit of history. Now, the first president to be officially impeached was President Andrew Johnson in 1968, but that was so long ago, I don't feel like that could shed light on our situation today. So the next president I looked at was President Richard Nixon. Now, he eventually resigned in 1974 due to impeachment proceedings against him, and a CNN news article posted this fall stated that from the initial inquiry to the actual resignation of President Richard Nixon, the stock market declined about 26%. And it was a pretty good sized bear market at the time. Now, how much of that had to do with President Richard Nixon and how much of it had to do with his policies, key word there, policies, and the other economic inputs that were taking place at the time. Now, in 1971, President Richard Nixon had inputted the Nixon shocks, which eventually resulted in the ending of the Bretton Woods Agreement. This had major financial implications not only for the US, but for the world in general. We also had the OPEC oil embargo, which raised the cost of oil by about 400% in a very short time period. We had rampant inflation and highly volatile interest rates that were rising rapidly. I feel like those other inputs had a much greater impact than the resignation of President Richard Nixon. Let's move on to Bill Clinton. President Bill Clinton was the second and only president of the United States to have been formally impeached. In December of 1998, the inquiry and impeachment proceedings were brought forward against President Bill Clinton regarding the whole Monica Lewinsky debacle. Enough said about that. It did succeed in going to the Senate, where he was acquitted and he was not removed from office, and he continued to finish his term. Now, the stock market at the time was in a raging bull market, and according to that same CNN news article that I talked about earlier, the stock market from the initial inquiry to the actual acquittal rose 27%, the almost exact opposite of what happened with President Richard Nixon. That makes things a little bit confusing, and it really doesn't give us a clear direction as to how an impeachment proceeding would affect the stock market either way. And I think it was all the other economic inputs that were happening at the time, and you just had a really great, strong economy, and it just sort of bounced off the economy and carried on. So what about President Trump? How likely is it that he might be impeached? Let's look at that. In order to have successful impeachment proceedings and have President Trump removed from office, it seems quite unlikely at this point, because you'd have to have him officially go through the impeachment process and then have it brought forward to the Senate, where they have a trial, and then they have to have a 2/3 majority vote to have him officially removed from office. So again, that seems unlikely at this point. And in any case, looking at history, although we've had very few examples to show us, it seems like there's very small input that would have in the stock market. The stock market seems to have less concern over actual politicking and more concern over actual policies that have an impact on the overall economy. So what does this mean for your portfolio? Now that we have this information, what are we going to do about it? Well, it's just like the old saw, be boring and make money. That, I believe, is trademarked by Maurer, but it's a common saying in our industry. And what it means is, if you have a tortoise and a hare, the tortoise is usually going to win because they keep chugging along. So it takes things like consistency and having a model that you follow, and you stick to it through thick and thin, whether the market's hot and whether it's not. Having a systematic savings plan doesn't sound sexy, but at the end of the year, after you've had 12 months of savings and you see those boring tortoise stocks in your portfolio and how they keep chugging along and they've made money or lost less money than other stocks that are available, and when you look at how much money you've had to save from your paychecks on a monthly basis, well, that can feel pretty darn good and maybe even a little bit sexy. I'm Anna Hilberry. Thank you for listening.